Welcome back to Talk Tickers. If you're a busy institutional investor, you are absolutely in the right place. We are the audio digest that reads the transcript so you don't have to. Today's Tuesday, February 3rd, 2026.
And it feels like a heavy Tuesday, doesn't it? The markets are definitely grinding.
They really are. And we're looking at a company today that is wading through what their own management is calling one of the longest downturns in history.
The petrochemical winter. It just keeps dragging on.
Yeah, the frostbite is setting in. We're unpacking the Q4 2025 earnings call for LyondellBasell, ticker symbol LYB.
LYB. And this is one of those calls where, if you just skim the headlines on your terminal, you might think the whole ship is sinking.
Right.
But if you actually sit down and read the transcript, which of course we did, you realize the strategy is incredibly aggressive. It's almost a case study in crisis management.
That's the perfect hook for this deep dive. The question we're asking is pretty simple. Can a company actually shrink its way to prosperity? Because Lyondell is posting losses. I mean, real accounting losses. Yet somehow, they're generating these massive piles of cash.
It's the classic value trap versus turnaround debate, isn't it? Are we looking at a sinking ship that's just, selling off the furniture to stay afloat?
Or is this a masterclass in cycle management where they come out of this leaner and meaner when the market finally turns?
Let's find out.
Okay, let's do it. Let's start with the snapshot, the numbers that hit the tape this morning. The headlines were, let's just call them mixed, to put it politely.
Mixed is very generous for the earnings per share. They missed widely.
How wide?
We're talking about a GAAP EPS loss of 45 cents. Now, the street was expecting a profit of 13 cents.
Oh, wow.
That is a 60-cent swing to the downside.
Yeah.
In this game, that's not just a miss, that's a whiff.
Ouch. Missing by 60 cents is tough. That usually triggers an immediate sell-off. But then you look at the top line, the revenue, and they actually beat.
Right. Revenue landed at $7.09 billion. The analysts were looking for $6.82 billion. So they moved more product than people thought.
Okay.
But, and this is the crucial context, that revenue number is still down over 25% year over year.
So they sold more than expected, but they sold it at much, much lower prices.
Exactly. The pricing power just isn't there. The industry is flooded with supply, so you're moving volume just to keep the system running, but you aren't making any margin on it.
Which explains the bottom line.
The bottom line. A net loss of $140 million for the quarter. Just red ink on the P&L.
And yet the market reaction was interesting. It wasn't a panic.
No, it was just volatility. Pure indecision. The stock opened higher, it swung wildly all day and closed down about 1.9% at $49.
Okay, so not catastrophic.
No, but the volume was the tell. 18 million shares traded. That is heavy volume for them. It tells me the market is really wrestling with the narrative here. It's a massive tug of war between the bears screaming, look at the losses, and the bulls saying, but look at the discipline.
That brings us right to the core paradox of this call. And this is where I really want to slow down and unpack this, because it sort of defies basic logic. You have a company posting a net loss, but the bank account is telling a completely different story.
This is exactly what the bulls are hanging their hats on. Despite that $140 million net loss, LyondellBasell generated $984 million in operating cash flow.
In the fourth quarter alone.
In Q4 alone. Just shy of $1 billion in cash. For the full year 2025, that number is $2.3 billion.
Okay, hold on. Nearly $1 billion in cash flow in a quarter where they lost money on paper. Walk me through that math. How do you lose earnings but find $1 billion in the couch cushions?
It sounds impossible, right? It comes down to a metric we call the cash conversion ratio. They hit 95%. That is the standout stat of the entire call.
95%.
In an industry where margins are crushed, converting 95% of your earnings, or in this case, your EBITDA proxy into cash, is exceptional.
But where did the cash come from, if not from profit?
It's what management calls self-help, but in accounting terms, it's working capital release. They released over $1 billion in working capital in Q4 alone.
Okay, for the listeners who aren't CPAs, break down working capital release for us.
Sure. Think of it this way. You have cash tied up in 3 places. Inventory sitting in your warehouse, bills customers haven't paid you yet, and bills you haven't paid your suppliers yet.
Okay.
To release cash, you do 3 things. You stop making new stuff and sell what's in the warehouse. You lower your inventory. You hound your customers to pay you faster. And you negotiate to pay your end bills later.
So they effectively liquidated a huge chunk of their inventory and just tightened the screws on their balance sheet.
Precisely. They ran the plant slower, sold off the stock they had sitting around, and managed the timing of payments aggressively. It's impressive discipline, but, and this is the big but, it's a one-time trick.
Right.
You can't release the same $1 billion of inventory twice. Once the shelf is empty, it's empty.
That's the catch. It's finite. But it wasn't just moving numbers around on a spreadsheet. They made some very real, very human cuts, too.
They did, and this is the painful part of that shrink to prosperity strategy. They detailed a global workforce reduction of 7%.
7%. What's that in real numbers?
That's approximately 1,350 employees let go. They are bringing their headcount back down to 2018 levels.
2018 levels? Wow. That's erasing 7 years of organizational growth. That feels like a company admitting they got too fat during the boom times.
It is exactly that admission. It's a massive restructuring. They're calling this controlling the controllables, which is classic corporate speak for we can't fix the market, so we're going to slash our own costs to the bone.
And they aren't done, right? They put a number on future savings.
They raised the target. They have a cash improvement plan. Again, note the focus on cash, not just earnings. And they're aiming for $1.3 billion in recurring savings by the end of 2026.
That's up from their previous targets.
Way up. And they explicitly promised an additional $500 million in incremental cash in 2026 relative to 2025.
So the strategy is crystal clear. Survive the winter by getting extremely lean. Let's dive into the specific segments, because petrochemicals is a broad term. What's actually happening on the ground?
Let's start with the engine room. O&P, America's olefins and polyolefins. Usually, this segment does the heavy lifting because of cheap U.S. energy.
And this quarter?
EBITDA came in at $164 million.
That seems really low for their flagship segment.
It is very low. It's barely a pulse compared to the glory days. They got hit by a double whammy. First, the cost advantage shrank. Higher ethane and natural gas costs in the U.S. squeezed their margins.
Okay, so the cost gap narrowed. And the second hit?
Winter storm, Fern.
Oh, of course. I feel like we name winter storms now just to give CEOs a specific excuse for bad quarters.
It is a convenient variable, I'll give you that, but in the chemical industry, it's very real. These plants are massive, complex beasts. They do not like freezing temperatures.
Right.
When the freeze hit the Gulf Coast, it disrupted operations significantly. Your plants go down unexpectedly, you lose volume, and you get hit with high restart costs. So nature actually did take a bite out of the P&L.
Okay, so the U.S. struggled. What about across the pond? Europe and Asia?
A total bloodbath. O&P, Europe and Asia, posted a loss of negative $61 million in EBITDA.
Negative EBITDA. So they're literally burning cash just to keep the lights on in those plants.
Effectively, yes. Europe is just battered. You have low demand because the European economy is sluggish, and you have all these cheap imports coming in from the Middle East and China.
So what's the plan there?
There is a strategic light at the end of the tunnel. Management confirmed that the divestiture of their 4 European assets is on track to close in Q2 2026.
That feels like a huge move. Getting out of those assets just stops the bleeding.
It does. It's a structural change. They are effectively cutting off the limb to save the body. They're acknowledging they just can't compete in those markets anymore.
Okay. Now, looking at the intermediates and derivatives segment, I&D, how'd they do?
EBITDA of just $25 million. This is a normalization story. In Q3, they had this huge spike in oxyfuels like gasoline additives because of outages elsewhere.
Right, you remember that.
In Q4, that supply came back online, prices dropped, and Lyondell's margins just went back to normal. It's a volatile business, and we saw that volatility to the downside this quarter.
But amidst all this red ink and storm damage, there was one bright spot, right?
Yeah.
Something called APS.
Yes, the surprise underdog.
Yeah.
Advanced Polymer Solutions, or APS. EBITDA was up 55% year over year to $38 million.
Up 55% is massive.
The percentage is massive, but the absolute number $38 million is still pretty small for a company this size. But the reason it's up is what's important.
Did everyone suddenly start buying fancy polymers?
No, actually. Auto demand, which is a huge driver for that segment, was soft. People aren't buying as many cars.
So then how?
This result was purely driven by cost discipline. They fixed the cost structure of that business. It's a proof point for management's whole argument that they can improve profitability even if the market doesn't help them. They basically proved their thesis in a microcosm within APS.
Okay, so if we zoom out, we've got the cost cuts, the headcount reduction, the asset sales. What does this all mean for 2026? What is the guidance looking like?
It's what I'd call a CapEx diet, a serious one. They guided 2026 capital expenditures to just $1.2 billion.
Is that low? Give us some context.
It's incredibly low for a company of this scale. To put that in perspective, they said $800 million of that is just maintenance keeping the plants running safe.
So that leaves only $400 million for growth projects.
Exactly. $400 million. That's tiny. You can burn through that on a single pilot plant. It implies they are delaying major projects.
Like what?
For example, MoreTech 2. Their big advanced recycling project, the future of the company, theoretically, is being pushed out. They are prioritizing cash preservation today over expansion tomorrow.
Which brings us to the elephant in the room, the dividend.
This was the hot topic during the Q&A. The analysts were all over it. Lyondell's dividend yield is currently twice that of its peers.
And when a yield gets that high, the market usually starts pricing in a cut. It's a big red flag.
It's flashing red, yeah.
So did management give any reassurance? Did they say the dividend is sacrosanct?
CEO Peter Van Acker was very careful. He was notably non-committal. He kept emphasizing that the investment-grade balance sheet is the #1 priority.
Uh-oh.
He said the board reviews the dividend regularly with the next meeting in February.
Reviews regularly is not exactly, you can sleep easy tonight.
Yeah.
That sounds like code for, we are crunching the numbers to see if we could still afford this thing.
It's exactly what it is. The takeaway is that the dividend is safe for now because they have that cash flow from the inventory release. But inventory release is a one-time trick. It's clearly weighing on their whole strategy. If this downturn drags on through all of 2026, something has to give.
That's the danger of eating your seed corn. You survive the winter, but you have nothing to plant in the spring.
Perfectly put. It's a very dangerous game of timing.
Let's zoom out a bit more. We talked about this being the longest downturn. Are there any signals from the macro environment? Any hope on the horizon?
There are two major signals we need to watch. The first is what we call capacity rationalization. The industry is finally responding to the supply glut. Management noted they see about 23 million tons of ethylene capacity being rationalized globally.
Rationalized meaning shut down for good.
Shut down, mothballed, scrapped. Older, less efficient plants are closing. That removes supply from the market, which should eventually help prices recover. It's the market's immune system finally kicking in.
Okay. And the second signal?
This is the fascinating one. And if you take nothing else away from this deep dive, listen to this. It's coming from China. We're calling it the anti-involution factor.
Anti-involution. That sounds like a sci-fi movie plot. What is that?
It does, doesn't it? But it's geopolitical. In China, involution, or Niwan, refers to intense competition that just leads to a race to the bottom. Everyone working harder for less and less money.
I think we've all felt that.
Right. It's a buzzword in Chinese social commentary, but now it's hitting industrial policy. The Chinese government, specifically the NDRC, their National Development and Reform Commission, is discussing policies to stop this in the petrochemical sector.
The NDRC is powerful. So what are they proposing?
They are looking at potentially forcing the closure of smaller crackers, specifically those under 500 kilotons of capacity. These are usually the older, dirtier, and less efficient ones.
That would be massive. China has been the source of so much new supply. If they start legislating shutdowns, that changes the global balance immediately.
It creates a price floor. And there's also talk of a consumption tax on naphtha in China.
Explain why a naphtha tax matters to an investor in LyondellBasell in, say, Houston.
It matters because of the feedstock spread. Asian producers mostly use naphtha as their raw ingredient to make plastic. Lyondell in the U.S. mostly uses cheap ethane from natural gas.
Okay.
If China puts a tax on naphtha, it makes the Asian producers way more expensive. It drives up their costs. That widens the advantage for U.S. producers like Lyondell. It effectively bails out the global market by punishing the high-cost producers in Asia.
So bringing it all back home, what's the so what here for the investor?
The narrative has shifted. It is no longer about growth. It is 100% about survival of the fittest. LyondellBasell is positioning itself to be the last man standing. They are trying to cut their own costs faster than market prices can fall.
It's the bull case, right? If the cycle turns, they're a coiled spring.
Exactly. If margins normalize, their cost structure is so lean because they fired all those people and sold the bad assets that profits will just explode upwards. They'll be printing money.
And the bear case.
The bear case is that this longest downturn isn't over. If it drags through all of 2026, that dividend looks incredibly heavy. And by cutting growth CapEx to just $400 million, They might survive today, but starve tomorrow.
It's a high-stakes poker game with the global economy.
It really is. And Lyondell is betting everything on their ability to be the most efficient operator at the table.
All right, that brings us to our favorite segment of the show. We've looked at the numbers, we've heard the spin. Now it's time for This Is Not Financial Advice.
Disclaimer time. We are just two voices in your headphones. We are not your financial advisors. Please do your own diligence.
Imagine you're an analyst at a hedge fund. You have to pitch a trade to the investment committee. What's the trade based on this call?
Okay, I'm pitching the China policy pivot pair trade.
I'm listening.
Here's the setup. The market is currently pricing in a perpetual glut in Asia. Sentiment is in the toilet for chemicals. But we just talked about those rumors, the Chinese consumption tax on naphtha, maybe $300 a ton, and the strict rationalization rules.
So how do we play it?
You go long LYB and you go short the Asian pure play naphtha crackers.
Walk me through the mechanics of that. Why does that work?
Because LyondellBasell is effectively a North American ethane play. Their input costs are natural gas-based. They have this massive $1.3 billion cost-cutting buffer. They can survive this winter.
Okay, so they're the survivor and the short side.
The Asian producers are mostly naphtha-based. If China slaps that $300 a ton tax on naphtha, their costs skyrocket overnight. If the anti-involution policy kicks in, the smaller players get shut down. You are shorting the guys who are about to get regulated out of business.
So the kicker here is?
The kicker is that you aren't betting on demand coming back. That's the beauty of it. Everyone else is waiting for the consumer to buy more plastic ducks. You don't need that. You are betting on supply being legislated out of existence in Asia.
Wow.
If China announces that policy in Q2, the spread between U.S. producers like LYB and the Asian naphtha producers just blows out completely.
You're betting on the stroke of a pen in Beijing, protected by the cost cuts in Houston.
Exactly. It's an arbitrage on regulation and feedstock. It's risky, but the asymmetry is there.
I love it. It's terrifying, but I love it. It relies on macro policy, not just hoping people buy more stuff.
That's the best kind of trade when the economy is stagnant.
All right, let's wrap this up. Recap for the people driving to work.
LYB Q4 2025. They missed earnings badly, beat on revenue. The real story, though, is the massive cash flow, $984 million from operations driven by aggressive inventory management.
The strategy is shrink and save.
Shrink and save until the cycle turns. Exactly.
And the final thought to leave everyone with.
The stock is trading on yield and cash preservation. The next quarter is going to be a massive test of credibility. Is that $1.3 billion savings target real? Or is it just some accounting magic? We need to see the proof. And keep a very close eye on that dividend meeting in February.
And remember, folks, Talk Tickers is for entertainment and informational purposes only. Nothing we said here is financial advice. Please do your homework.
Absolutely.
We'll be watching the tickers so you don't have to. Thanks for listening.
See you next time.